As we also committed to the capital market, we want to show strong organic cloud growth, which we are doing. We are not buying companies just for the sake of buying revenue. Now, of course, going forward, as we also said today in earnings, we are very confident. We see further acceleration of our cloud revenue growth also in the quarters to come. And over time, and with SAP, we are now seeing a massive movement of our installed base to our business technology platform in the cloud. And of course, we see a much higher adoption of S4HANA Cloud, our flagship ERP solution. So there is more to come in the next quarters, and we are absolutely confident that we are catching up also on the cloud revenue side and that we see also high growth in the upcoming quarters.
So you just said yourself, and you've been framing this for a while, that you are completely shifting the business to focus on cloud subscription businesses, from business revenue from that. Why now? Your competitors have been doing this for a long time. Did you come late to that game?
First of all, in the pandemic, a lot of customers came to us and said, hey, a technical migration is not enough to a hyperscaler, to a cloud infrastructure. Because with a technical migration, I'm not changing my business model. That's why we launched RISE with SAP, where we are giving our customers access to the best practices of over 400,000 customers to help them to adapt to new business models. Second, look at the fragile supply chains these days. SAP has the technology for that in the cloud. We are running the world's largest business network. And when we are now talking about semiconductor shortage, or look at all the container ships there in front of the harbors, this is where SAP can help, again, in the cloud. And third, sustainability is another key pillar of our portfolio. And also there, we are investing into innovations in the cloud to measure carbon footprint as we are running the warehouses, as we are running the factories across the globe. And this is why it was the right time to pivot the company to the cloud, also in the core ERP business.
And you don't see any slowdown in enterprise spending at the moment?
Actually, we see just the opposite. I mean, of course, during the pandemic, we saw a huge surge in our e-commerce business, in supply chain. We, of course, running with S4HANA new business models. But now what we're also seeing, we see a huge demand around our sustainability portfolio. We see actually more and more companies who want to join our business network to overcome the supply chain disruption. So again, I'm very optimistic as technology will solve some of the biggest challenges we have, also as a community.
A lot of people look at SAP as a kind of barometer for enterprise tech spending, and so far it's flashing a green light. It's seeing 20% growth in cloud, really strong demand, but the market isn't giving it a ton of credit. The stock is up 11% this year. Salesforce is up 3 times that. Oracle's up 5 times that. And I asked Christian about that. He said that once the market figures out the transition this company really is making into subscription business cloud, that he thinks they'll be rewarded, and he doesn't see any slowdown. I also like how he did a little dig at Benioff for buying growth instead of growing it organically. Anyway, Christian Klein, thank you. Thanks to him from SAP.
We should mention as well, by the way, that markets are at record highs as we speak. Anything positive, pretty much anything positive, a point or half a point on the S&P will be a record all-time closing high. We're up 0.2% as we speak, so we are on track for that record close. NASDAQ is higher by 0.6%, but a little way off still. The Dow some way off. Time for a CNBC News Update with Frank Collin. Hi, Frank.
Hey there, Wolf. I'm Frank Collin. Here's your CNBC News Update at this hour. The U.S. Army and Navy testing components for America's hypersonic weapons programs. The Pentagon says the 3 tests were successful. However, Reuters is reporting at least one other test was delayed when a booster rocket failed to ignite. In Haiti's capital, streets getting blocked with burning tires and barricades to protest fuel shortages and kidnapping by gangs. Gangs are also blamed for hijacking gasoline supply trucks, which is intensifying those shortages. Meanwhile, the head of the gang believed to have kidnapped 17 American and Canadian missionaries says he will kill them if his demands are not met. And Russian President Vladimir Putin says he is considering removing the Taliban from a list of extremist organizations. The Kremlin labeled the Taliban a terrorist organization in 2003, but then held talks with Taliban officials several times before the group seized power in Afghanistan. Putin also saying President Biden was right to withdraw U.S. troops from Afghanistan. Sarah, back over to you.
Frank Collin. Frank, thank you. After the break, WeWork finally going public more than 2 years after its failed attempt at an IPO. We'll bring you the details next. It is higher by more than 7%. And later, an exclusive interview With Dow CEO Jim Fitterling on the back of those results, that stock, along with IBM, pressuring the broader market today. What he sees in terms of demand, chemicals always a key component. And as we had to break, a check for you on bonds. Yields are higher again today. 10-year yield marching all the way up to 1.68%, just about, which is dictating a lot of the trading action. Those inflation expectations are higher, staples are lower, and industrials, healthcare, communication services all higher. We'll be right back. It has been 2 years since WeWork's IPO plans blew up in spectacular fashion. But today, the company finally hit the public market. Deirdre Bosa with the story. Went better this time, Deirdre, at a fraction of the valuation.
Yeah, finally is right. And the company looks a little different today. For one, it is worth about $40 billion less. And there is an entirely new leadership team steeped in real estate experience, not technology. But this is an important milestone and one that at one point many doubted might ever happen. Now, CEO Sandeep Mathrani and SoftBank COO Marcelo Clary, they were on hand at the New York Stock Exchange to mark the debut. Meanwhile, ousted CEO and founder Adam Neumann, who still has an 11% stake, he celebrated uptown, not far away, with what he called the original team.
This has always been about the team and about what we did together, and we're just so proud today and for this day. and we just want to congratulate the current WeWork team, and we want to congratulate Marcelo and Sandeep for executing on this team's vision.
But Sarah and Wolf, there is still, however, plenty more executing to do. WeWork's management team told SPAC investors that it will reach 70% occupancy by the end of the year and break even in terms of adjusted EBITDA. As of the end of Q2, though, they were far from that goal. And of course, remember, they're still losing billions in terms of net income. So some things don't change. Back to you.
Dee, thanks so much. What a story that was. It does feel like a big result for them, even though it's far, far below those valuations of a few years ago. Dee Bosa. Coming up, auto retailer Lithia Motors posting strong results. The company seeing a 90% increase in used vehicle revenues. We'll dive into the quarter with the CEO next. Lithia Motors reporting an earnings beat and a sales surge of more than 70% year over year, despite concerns over a slowdown in auto sales amid the chip shortage. I caught up with the CEO of Lithia Motors, Brian DeBurr, and got his take on what he's seeing from customers.
We've been able to balance the shortages in new cars with very robust used car sales. We have almost 18,000 cars on our driveway and Lithia websites in used cars, and we're up 40% in revenue on a same-store basis in the quarter.
And does that exposure to used cars hedge your exposure to new cars during the chip shortage? Is it nonetheless something that you expect and hope will abate because the margins are better on new car sales?
Well, margins are pretty strong right now on both segments. And I think most importantly, I think the ability to have both used and new cars in our stores and online does give us the ability to provide optionality to our consumers, which allows the flexibility in our profitability and really realize those benefits across the company.
What are you hearing from the automakers on the chip shortage? Do you think we're past the worst of it, or is it going to get worse before it gets better?
It's definitely a mixed bag. It appears like we've troughed in a number of manufacturers, that we have seen the worst of it, sitting around 20-day supplies in some of those. I do believe, though, that because demand is so robust out there, that it's probably going to take into the middle of next year before things really recover to more of a normal level.
With Driveway, your buy and sell online service, do you see that as a hedge against the changing nature of retail and the changing nature of your industry in particular, and allow you to have a hedge against the dealership business if that declines?
That's fair. And I think when we think about optionality for the consumers, what Driveway does is allows them to have the convenience of in-home delivery, as well as the transparency and empowerment of being in control of their own environment online to be able to do that. On top of that, our traditional businesses in Lithia, our e-commerce business, and that is almost 25% of our sales, or almost $5.5 billion annualized. So it's a pretty good part of our normal business, having our 300 local and regional brands as well.
On the flip side, I know you are buying more dealerships. Is that more a geographic expansion play?
It is. So we've defined our country as 6 specific regions, where we specifically target to try to achieve a density in our region of about 100 miles from all customers in the country. And we've done a good job on that in 4 of our 6 regions. We've grown at about we've now purchased over $10 billion in revenue in the last 15 months, and grown the company almost 60% in total revenue base, and expanded that density from about a 500-mile average reach now down to about 225-mile reach.
Lithia Motors CEO there, Sarah, and they've got plenty of hedges within their business to the chip shortage, as we just heard, because of those used car sales. But interesting that new car sales were still up about 50% year over year, and growing despite the chip shortage.
70% revenue growth. Unbelievable, despite those shortages. When we come back, it was a big day for the airlines, with Southwest, Alaska, and American all reporting. We'll hear from American Airlines CEO about the quarter and what's driving profitability. Dow's down 54 points as the SP 500 is at a record high.
Just over 10 minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. And today we've got Hightower chief investment strategist Stephanie Link as well. Let's kick things off with the broader markets. A mixed picture for stocks today with the Dow moving lower. The SP500 is up for its 7th straight session, currently on track for a record close. Atlanta Fed President Raphael Bostic joined us earlier in the hour and told us he has one rate hike penciled in for 2022. I asked him when he predicts that first rate hike will come.
I haven't done a probability tracking on sort of when in the year. I was thinking late third, maybe early fourth quarter for 2022. Again, this is with the projection that we would get back to full employment in the late summer. And so we would really have achieved both parts of our dual mandate in a way that would, according to our long-run framework, give us the space to start to pull back in terms of our policy position. So a lot of this has to do with my confidence in the U.S. economy, my confidence in the labor markets responding to this demand, and us getting to a very positive place within the year.
Mike, one rate hike towards the end of sort of Q3-ish probably wouldn't hurt the market too much. It's kind of where they're at the moment. And also on top of that, quite impressive to see us sitting at a record high on the S&P with the way yields have moved up today and this week anyway.
Yeah, the market is there. September is the end of the third quarter next year. That's roughly when we're now handicapping the first rate hike. So, yeah, we're absorbing that. Again, it's all contingent. So for full employment, by whatever definition by the summer, I think it probably would be fine. The first rate hike usually is not the killer for any bull market, even though sometimes there's some scares before you get to that point. So I think that fits together. Yes, yields have had an aggressive move. And what's interesting is the market is not conforming to the old script, right? Because you have a handful of very large growth stocks that are really responsible for all the upside today. It's Tesla, Netflix, Microsoft. And you actually have the industrials and cyclicals that are lower. To me, it's just noise. We've made a round trip back to the highs and trying to kind of assimilate whether this is the end of this yield move, for the moment, or if it's up and away.
Yeah, some of the consumer stocks are actually working today. Steph, it is remarkable. 7 days in a row of gains back up to record highs. The market really has climbed this wall of worry, whether it's the Fed or fiscal policy or slowing growth, slowing earnings growth. What do you chalk it up to?
Well, we always worry about something. We talk about this all the time. I worry when we don't worry, because that means we're so totally complacent. But I think it really is that we're into the seasonally strong period of the year for the markets, the fourth quarter. We're past the volatility in August, September, and the beginning of October. And now you get earnings, and earnings are coming in quite strong. Now, we not only are earnings coming in strong, but you still have an enormous amount of liquidity, Sarah. You know this, 47% of the GDP in liquidity. And that's enormous, right? And that's not going away overnight, even if the Fed tapers. Interest rates are rising. I think they're rising for the right reasons, because there's better growth and more inflation. We do root for a little inflation, by the way, not a ton. I don't think we're going to have a runaway inflation, but we're going to have pockets. And this is what the companies are talking about during earnings season so far. And then most importantly, the biggest part of the economy is the consumer, and they're doing just fine. Retail sales have been very strong for the last 2 months that not a lot of people are talking about. Housing continues to remain strong. Manufacturing, all these companies this week did a really good job in terms of talking about demand being there and having some problems on the cost side. But we've talked about this, too. You have the haves and the have-nots. And those that have pricing power are going to do just fine. Dow, Procter & Gamble, J.B. Hunt, Dover, Union Pacific are just some examples of pricing power companies. Those are where you want to have exposure. And then also, you want to have exposure where you don't have to worry about this when you look at something like an Abbott or United Healthcare or a J&J. So diversification across the board still remains the key.
Dow CEO coming up in the next hour on this show. A trio of big airlines reporting quarterly results today. Phil LeBeau with the details we need to know. Phil.
Sarah, let's start with Alaska Airlines, the one airline that reported today and posted a profit, coming in better than expected at $1.47 a share. There you see the reaction. Didn't really do anything after they posted that profit. When we talked with the CEO earlier today, he said the staffing shortages that have been reported around the country in different places and with them, it is not impacting them or causing them to reduce flights. In fact, they are gradually adding capacity in the fourth quarter into next year. As for Southwest Airlines, it posted a loss in the third quarter, but better than expected, 23 cents share loss compared to 27 cents. The CEO says flight cancellations. That surge of them a week and a half ago cost the company $75 million. They believe that they have rectified that situation, and moving forward, they will be in a better position when it comes to adding flights and dealing with the pandemic. Finally, there is American Airlines also posting a Q3 loss, better than many people were expecting, a smaller than expected loss. And when we talked with Doug Parker earlier this morning at American's headquarters, he said the key to getting to profitability, corporate travel.
I got to be careful about making specific financial forecasts, of course. But what I know is, once business travel comes back, which it will, you'll see all of us return to profitability.
And there you have American Airlines. By the way, Doug Parker also told us that he believes that the Justice Department is wrong when it comes to the Northeast Alliance it was trying to unwind between American and JetBlue. By the way, we hear from JetBlue next week. Guys, back to you.
Philippo, thanks so much, as always. Shares of IBM plunging today following its earnings last night. The company beat on EPS but missed on revenue. Ritholtz Wealth Management's Josh Brown weighed in on IBM yesterday and told us why he's not interested in owning the stock.
It's a very, very boring business that nobody's excited about. It trades at a reasonable valuation, but it always has. It buys back a lot of stock, but the stock always ends up lower. It peaked in 2011. It's been in a 10-year downtrend. It is really an impossible stock to invest in. You know how bad it is? Warren Buffett found a way to lose money in IBM, and he didn't buy it at the high. I feel like everything they do is 3 years too late. So, I'm not in it. I'm not looking at it. I'm not interested in being an investor or a trader here, and may God have mercy on everyone's soul that's involved. It's just not been fun.
That includes you, Steph.
Clear words there from Josh. Steph, what's the counter argument?
Well, he and I have debated over a lot of names. I'm more of a value investor. He's more of a momentum investor. And I just got into this stock about maybe 2 quarters ago. And remember, this was a terrible quarter in 3Q. But in 1Q and 2Q, they actually beat. They actually were able to execute. And the reason I own it is not for their legacy businesses. I own it because they're totally transforming their company. They have asset sales. They have spin-outs. They're spinning out Kyndryl, which is their infrastructure outsourcing business, which, by the way, is going to help add to 3 points to sales next year. They're focusing on growth businesses, cloud, AI, blockchain, Red Hat. And they're making a ton of acquisitions. They reiterated the $35 billion in free cash flow that they're going to generate over the next 3 years, and they're going to make more M&A, find more growth businesses, and I like that strategy. In the meantime, it's 13 times earnings, it's a 5% yield, and I do like that free cash flow yield as well. So I'm not owning it for legacy. I'm owning it for what's to come. And at this valuation, with this yield, I'm willing to wait.
But even though the growth businesses saw their rate of growth slow down, that seems like something even the Bulls were frustrated about.
I think there were two pieces. Yeah, the growth the cloud business did slow a bit. They saw some push-outs, and they also said that Kyndryl, they saw some push-outs as well in terms of projects because of next year's mainframe cycle and ELA renewals. So I think there's a lot that's going to happen in 2022. Am I disappointed today? Absolutely, I'm disappointed. But I bought this only about 2 quarters ago, and I really felt like there were some interesting changes underway, and restructurings take time. People said the same thing to me about GE, and it was up 78% last year. So I don't have a ton of these kind of names in my portfolio, but I did find this one compelling with the new management team as well.
Mike, 90 seconds left, and record close for the S&P.
Yes, S&P new intraday close on track for a new closing high, but we do have some negative breadth under the surface, so it has been a very narrow rally just for today, not in general. So not quite 2-to-1 to the downside. Take a look at the 5-year note yield. This has been one of the more aggressive maturities in terms of those yields surging, making new highs since February of 2020, right before the COVID crash. Also market implied inflation over the next 5 years is now close to 3%. So clearly there's some momentum to this move. We'll see if it's going to run out of steam. Volatility index actually under 15 for the first time since right around that early July period that I was talking about earlier that the current moment resembles. You got a little bit more kind of methodical tack on upside and then some chop.
We've got 30 seconds left, and we're at the highs of the session as we approach the close. The Dow might even go positive in these last few moments. But importantly, it is the S&P that it is up 0.3%, set for a record closing high. Once again, the Nasdaq, though, leads the charge of the major averages, up 0.6%. The best performing sector is consumer discretionary, up 1.4%. As Mike says, not the best breath. Energy is down 1.8%, but at the bell, a record closing high for the S&P 500 once again, and the Dow going just positive into the close.
Seven straight days. Welcome back, everyone, to Closing Bell. I'm Sarah Eisen here with Wilfred Frost and Mike Santoli, CNBC senior markets commentator. Take a look at how we finished up the day on Wall Street. Flat for the Dow, and look at what happened just in those final moments of trade, climbing all the way back toward the flat line after the Dow underperformed all day. It was weakened by the likes of IBM, which shaved 87 points off the Dow. Caterpillar, American Express, some of the cyclicals actually hurting. United Health, the biggest contributor to the Dow gains, along with Home Depot and Nike. S&P 500 closing at a record high for the first time since September 2nd, up 13 points on the day. It was led by consumer discretionary, healthcare, and technology, though you did have some weakness there. Wilfred mentioned energy, financials, materials, and staples all closed lower as well. Nasdaq climbed 0.6%. It was a good day for those big cap tech names. Tesla leading the charge, Microsoft, Nvidia, Netflix, Amazon, all higher in the session. PayPal still facing some pressure over a word of a potential deal with Pinterest. The small caps closed up 1/3% as well. We've got a huge hour of earnings coming your way. Instant analysis of results for you from Intel, Snap, Chipotle, Mattel, Whirlpool, and Boston Beer. It's a diversified set of earnings. Stephanie Ling from Hightower is still with us. Tiffany McGee from Pivotal Advisors joined the conversation. First, though, to you, Mike, hard to believe we're back at a record high. First time since early September, after September was pretty brutal for the bulls.
7-week round trip. It's been a little bit become more of a slow motion stampede in the last couple of days. Really light volumes. Nobody really aggressively selling into these this return to the highs today. You got to thank Tesla, Netflix, and Microsoft for getting us over the edge. It's honestly good to get it out of the way rather than lingering at the old highs and figuring out if it's going to be a resistance point and then talking about it. Now we are back in that zone. Even if, as I said, 7 straight days in a row, it's getting to be a little bit of a stretch just in a very, very short term.
We are going to continue the market discussion in just a moment, but we've got some breaking news out of Washington on the spending bill. Kayla Tausche has it for us. Hi, Kayla.
Hey, Wilf, as the White House and top Democrats discuss the future of possible tax hikes on corporations and wealthy individuals to pay for this massive social spending package, we've learned that the White House has recently communicated, as of last night, to top committees on Capitol Hill, specific guardrails on 2 other programs to try to shore up some revenue or at least limit the cost of these programs as they try to work toward a compromise framework in the coming days on this package. Specifically, White House officials communicated to these committees that they wanted to limit the child tax credit to 1 year from 5 years, and that they wanted significant cutbacks on who would qualify for a paid leave program. The first iteration of the program was a 12-week program that would be permanent, and essentially anyone could qualify for it. But the guardrails that the White House set in this call last night were significantly curtailed from that. Under this program, it would begin in 2024. Individuals could only qualify if they were making less than $150,000. And it would only last as long as the $100 billion in funding allocated to it would last. And my sources say that would be roughly 4 years. Now, of course, the White House has long said that compromise is hard, but it is needed to get a package, and that the ideal for the White House would be the original proposal and not what's going to end up going through the legislative process. But this is a significant cutback to some of these programs. But of course, anything and everything seems to still be on the table as they try to bring the cost down and bring the revenue up, and we'll see what other sources they can get it from. Wilf and Sarah.
Kayla, thanks so much for that. Let's bring that all together. Tiffany, with a view on the market and the record highs, do you think that it's justified there were these record highs again?
I'm probably not the person to ask that question. I mean, listen, I think certainly there's a case for for justification along certain names, right? And so we're really seeing this this volatility, kind of like these dips, and then of course clearly now these highs. But we've all been talking about this, and this is to be expected. And I think investors really should be thinking about this kind of active versus passive conversation. This is the case for active management, right? So there are some very clear winners across the board here. And what was it? Maybe like 2 weeks ago, when we were having those dips, and we were having these conversations about okay, do you buy the dip? Well, if people did buy the dip in some of these names, now they're kind of seeing the benefit. And so it really is the case for active management for individual stock selection.
Speaking of that, Steph, you mentioned that you want to own the stocks with pricing power in this inflationary environment. And I think you threw out Dow and P&G, both of which didn't react well to their earnings. So were you buyers on those dips? Were you a buyer on those dips?
I really do like Dow very much. He's been executing for several quarters since they split from DuPont. I also like Corteva, which is the other split from DuPont, Dow DuPont. I like them very much. I think Dow has done a great job, not only pricing power, but cutting costs, restructuring, building cash flow, paying down debt. So I like that story, and it's the cyclical side of my portfolio for sure. P&G, I was actually I don't own it, but I was pretty impressed that they're going to see 90 cents worth of headwinds from inflation and freight costs, and they actually maintained their guidance. That's pretty darn impressive in my mind. I just think that the staple stocks are expensive. So is P&G, and P&G's in that. My staple, as you know, that I like is Coke, and my other staple or it's not a staple, but it acts like a staple, is McDonald's, and those have kind of special situation stories. But yeah, you've got to really look hard at some of these companies that have got this pricing power, because inflation's here to stay.
Intel earnings just out, big bottom line beat. Let's go to Josh Lipton with the numbers. Josh.
Sarah, Intel reporting Q3 results here. EPS of $1.71 in the quarter versus expectations of $1.11. Revenue $18.1 billion in the quarter versus expectations of $18.24 billion. For Q4, they're looking for 90 cents. That's versus expectations of $1.01 on the street. And for revenue, $18.3 billion is the guide versus estimates of $18.25 billion. Segment CCG, chips for PCs, $9.7 billion. The street was at $9.6 billion. DCG, chips for servers, $6.5 billion versus expectations of $6.6 billion. We also should point out Intel CFO George Davis announcing plans to retire in May of next year. This conference call kicks off at 5 p.m. Eastern. Back to you all.
Looks like that revenue, Josh, thank you. Revenue miss is what is causing the stock reaction down more than 6% after hours, Mike.
Yeah, the revenue miss, guidance not necessarily dazzling. Stock is essentially kind of reversing to where it traded a week ago. It did have a little bit of a run as the market has bounced here. So it's been a struggle. It sort of looks quite cheap based on today's earnings and not. But next year is supposed to be, by the consensus, not a growth year at all for the bottom line. So it's a waiting game.
Steph, what's your take on this? Disappointing again.
Yeah, this is one of the reasons why I sold it, because they've been very inconsistent, and they're lowering guidance. At least what I can say at IBM, they didn't lower guidance. So they're lowering guidance. It's probably has to do with the shortages. But what's the most important number to look for is the CapEx number of $19 to $20 billion. Are they going to up that number as they build out their foundry business? The foundry business is going to take years to really complete. It's just what they're willing to spend to get to that point. I think it's the right decision, but in the meantime, I think the earnings and revenues kind of tread water.
Do you like AMD better on the market share story? Is that still the trade, or is there a different semiconductor?
Yeah. Oh. No. It's absolutely they're executing better, taking market share. They've got like a 2-year window going forward. So the only problem with AMD is it's just expensive. That's all. But they definitely are taking share, and that's the exciting part of the story for sure.
Tiffany, pivoting away from those specific earnings numbers, do you think earnings season as a whole is doing what it needed to do in terms of delivering these market gains? Banks felt stronger than this week's earnings.
Yeah, they did. And I think, banks really, always kind of set the tone for earnings season. And I think, what the bank earnings told us was that corporations overall really should be strong, right? And then also consumers were strong, right? Consumers were paying off their debt. It really kind of reflected by the lower revenues generated by credit card balances, right? And also paying off loans. So I felt really good the other week. And so listen, now, we're kind of getting into the thick of it. And certainly I think that we're going to have a lot of people still continuing to talk about supply chain, about labor costs. So I'm kind of waiting to see also, of course, freight costs, all of these increased costs, which I think is really going to kind of weave this, weave in like a theme throughout earnings season. So I'm really excited to see, really interested to see what Chipotle says as well too. I know it's coming up in a minute in terms of commodity costs and food costs as well.
While we wait for more earnings, let's talk about the stock of the day, DWAC, and President Donald Trump, the return of the meme stock. What did it close up? 400% or something? This
almost
is almost
350%.
And he's going to have a social media.
So it's a SPAC. It's merging in with a startup, essentially, based on with the involvement of President Trump, social media, alternative social media, et cetera. It's a lot of promise. It's unusual for a SPAC merger in that it's merging in with a business that doesn't yet really have operations. What's fascinating is the stock traded $12.5 billion worth of shares today. Second on the NASDAQ only to Tesla at $27 billion, and Apple only traded $9 billion.
I want to come back to that in a moment later in the show, but talking of social media, Snap is out and it's sliding 15% in after-hours trade, and that's because of a disappointing guide for Q4. Let's quickly get to the past quarter, though, first. Revenue was $1.07 billion. That was a fraction behind the forecast of 1.1. EPS was a nice beat, 17 cents. The forecast was for 8 cents. And daily active users came in at 306 million. The forecast was for 302 million. So everything of the past quarter looked fairly solid. But the guide going forward, a little soft. So the guide for revenue was 1.16 to 1.2 billion. The expectation was for a bit higher than that, closer to 1.4 billion. And I need to dig into a bit of the other areas there on the guide. There also was some comments about the Apple operating service that was rolled out in June and July has had an effect on them and advertisers across the board. And that is one of the factors probably that's weighing. Wow, it's down at 25%.
Yeah, that's a bloodbath. Yeah, that's been one of the big fears. Obviously, Facebook has talked about this.
But it didn't affect the past quarter's numbers
on Facebook. Well, it just kind of kicked in terms of the ad targeting and things like that. Facebook is now after hours down, I think $13. So this is it's going to bite a little bit here. Take Snap back to where it traded in July.
But I'm just saying that the past quarter, they're saying it started to take effect June, July, and they're seeing the effect of it in these comments. But the past quarter was a beat. Right. I mean, at least on the EPS line, and not far behind on the revenue line. Right. So kind of interesting that you're seeing such a strong reaction to what is just something in the comments section. Without it, tanking the numbers as yet.
So they mentioned the iOS platform changes, as well as global supply chain issues and labor shortages impacting our partners. According to Evan Spiegel in the release, we'll continue to focus on delivering strong results for our advertising partners and innovating to expand the capability of the platform. Steph, they did see user growth, but clearly a huge disappointment there on revenues and on the outlook.
Yeah, it was disappointing, and DAUs were disappointing. The whisper numbers were 312, right? So they came in less than that. This stock is up 51% year to date. It is versus the group of up 19. And since last quarter, it's up 23% versus the S&P up 2. So it's had a rocket ship of a move year to date and since last quarter. And they needed to just crush the numbers. And they also needed to guide to 50% growth, because that's what they've been saying all along, that that's their sustainable growth rate. And that's the revenue guide. And if that, I don't know what that number came in at, but if it's below 50%, people will be very disappointed. And so I get why the stock is selling off. They needed to crush it. They needed to crush it, and they didn't.
25% is a big sell-off. It's dragging down Facebook as well. We should mention. I just think kind of astonishing scale of a slide for something that was a miss, but not a massive miss on the numbers. And I think it'd be interesting on the earnings call to have more color from them on what exactly is the scale of the issue with the iOS changes. Perhaps it's one where the comments have spooked things more than the earnings call will, so that'll be a key one to listen to later.
It's also had a good run up.
It's had a great run.
100% in the last 12 months.
Last quarter after earnings, it jumped 16-17% or so. So of course that is a factor. We'll get back to that one in more detail. We've got an analyst coming up shortly. But meanwhile, Chipotle numbers are out, and they're a little less negative. Kate.
Hey, Wilf, that's right. Good third quarter here for Chipotle. Same-store sales better than expected at 15.1% versus estimates of 14%. I'll take you through the numbers, too. EPS a beat here, $7.02 adjusted compared to estimates of $6.32 for the quarter. Revenues also a beat, $1.95 billion compared to estimates of $1.94 billion rather for the quarter. Digital sales up 8.6 year-on-year to $840 million. They represented about 42.8% of sales. More than half of those were from order-ahead transactions. Restaurant-level operating margin 23.5%, up from 19.5% last year due to leverage from menu prices, but offset by wage inflation and higher beef and freight costs. The company says there's ongoing strength in digital, in-restaurant sales recovery, and new menu items contributed to its revenue growth. It also noted staffing and inflationary pressures as well as COVID uncertainty in Q4, but it is guiding for comps to be in the low to mid double digits range due to underlying business momentum. Chipotle CEO Brian Niccol is going to join us for a First on CNBC interview tomorrow on Power Lunch at 2:15. Tune in for more on that. And the conference call kicks off at 4:30. We'll bring you any other updates as we get them. The stock is higher by about 2% right now, guys. Back over to you.
That's a company with pricing power. Thank you, Kate Rogers. Mattel earnings also just out. Let's hit that with Christina Portsanevelos. Christina.
We are seeing a double beat on the top and bottom line. Earnings per share for Mattel coming in at 84 cents. That's higher than what the street was expecting at 72 cents. On revenue, what did they bring for the third quarter? They had revenue of $1.76 billion, higher than anticipated of what the street was expecting at 1.68. Keep in mind, Mattel has increased prices to offset the increase in price of raw materials as well as freight costs. And just about a week ago, you had analysts at UBS saying that the supply chain issues might be overblown for both Hasbro and Mattel, saying that their toy supplies will be okay for the holiday season. And you can see the share price up over 4.5%. Back to you guys.
Christina, thank you. Also tonight, be sure to watch Mad Money because Jim Cramer will be speaking to the CEO of Mattel, Ynon Kreiz, about these results. Chipotle, I'm watching up 2%. Mattel also up 4.5% right now. Snap's down almost 30%. Wow, 28%. Tiffany, I think you wanted to focus on Snap in particular. Do you own this stock?
I do own Snap, and it's really surprising that it's down because it was not really a big miss. But here's what's really interesting about Snap. So Snap really owns the young users, right? So if you look at who's using Snap, it really is younger kids. Versus like a Facebook where it really is, dare I say, older people. And so those young users are so important to ad dollars because the younger the user, they haven't really formed their buying habits yet, right? And so those users are far more expensive, right? Snap can charge more for those advertising dollars than say a Facebook can. And so really, that's really, really interesting to me because that really is the social media platform for everyone. I would say certainly under 20. And then also, they're going to be, Snap's going to be introducing this kind of like family engagement, which really kind of gives parents a better visibility into how their teens are using the service. And that's, really, again, kind of comparing them to Facebook, where we had all of those, this kind of like controversial practices. This is really looking, a lot better from a parental standpoint, from a social responsibility standpoint. And so overall, because we also look at ESG scores, Snap's ESG scores are really some of the highest in social media. So yeah, we definitely like them.
Tiffany and Steph, thank you both very much for joining us. I will just say once again, the revenue guide was only slightly behind expectations. The reaction is extraordinary, down a third.
I mean, a company that's not yet profitable and is supposed to grow revenues tremendously to try to grow into a valuation. I think that's why you see that outsized, like over-leveraged reaction in the stock to small changes in expectations.
Do you think it's reacting to a slight miss in the revenue guide, or do you think it's reacting to one or two lines where they're talking about the Apple iOS rollout and we don't know what that means yet?
Well, they also missed on DAUs. They missed on ARPUs, revenue per user. Looks like came in a little light as well. So not a perfect quarter.
No, but a third of your value. Let's see. Let's see where we settle at the end of the week after the earnings call tomorrow. Up next, much more on Snap's sales miss and ad warning. We'll ask an analyst what he wants to hear during the company's call. And later, the CEO of chemical giant Dow on how supply chain issues are impacting his company's bottom line. We're back in a couple minutes. Shares of Snap falling sharply, down 26% after reporting earnings moments ago. Let's get to Ali Mugharabi, who joins us to discuss these numbers. Talk us through this reaction. Is it overdone? Is it justified?
Well, I mean, based on the data that we have right now, it looks like it's a little bit overdone. But what I would say is a couple of things actually stood out. I think the DAU number was actually pretty good. But what stood out was actually slight deceleration in the monetization of those users. So we're talking about the ARPUs. And that actually does indicate the impact of some of the Apple changes. So basically, what we can assume is that the ad prices have gone down, specifically on this platform. Now, in terms of how it may actually impact, for example, Google's YouTube and or Facebook, what I would say is that those companies have a much, much larger user base, which at the end of the day continues to attract more advertisers and more ad dollars. So I don't think the impact on those firms would be as significant as it may be here on Snap.
We're obviously all, Ali, keying off only a couple of bullet points and comments as it regards to the new iOS changes from Apple. If they comment on the conference call that this is probably going to be something that's temporary whilst everyone in the industry is adjusting to it, would that abate some of your fears as to how long and lasting and severe the ARPU impact will be, or is it sort of understandable that people are reacting negatively to an ARPU miss?
Wilfred, I agree with you. I think that if they do comment that they are actually seeking or going down certain paths to address this issue in the short to medium term, I think the market will actually like that type of response. What I would say is that actually recently they have made some moves that indicates that they're moving more towards providing additional opportunities for the advertisers. So as you guys know, Arcadia, basically the ad studio that they've begun to create, that probably will give the advertisers more flexibility to basically be creative and create better messages, augmented reality-based messages and so forth, and possibly get the attention of the younger users. So they are taking steps towards addressing what Apple has done recently.
In the opening quote, they do blame the iOS changes. They also blame supply chain issues and labor shortages of our partners. Is that a reference to Apple or advertisers or what?
Yeah, that's tough to tell right now. I would wait for the call to get a better idea about what they mean. But it could be that the supply chain issues may be impacting some of the advertisers, and for the time being, in the short term, of course, that's what we're assuming. In the short term, the advertisers may be just putting aside some of the ad dollars and waiting for the supply chain issues to improve.
So if we got Snap down 25%, Facebook last look I think was down about 8%. We'll put it up on the screen any second now. Is that an overreaction from Facebook?
I would say yes. I would say that's an overreaction for Facebook. Again, Facebook with nearly 3 billion users out there, and with Instagram that does actually target and does attract younger users. I think the advertisers would still prioritize purchasing ads on the Facebook platform rather than some of the smaller players such as Snap.
You're on hold at $74 for Snap. Are you going to bring down that target price to match what's happening?
Well, that's a good question, but it really depends on what we hear during the call and how these new numbers are going to impact our projections. So we'll see.
We'll check back. Ali, thank you very much for your first reaction. Snap down 25% almost right now. Intel shares are also slumping after missing revenue estimates. Up next, we'll get reaction from an analyst who thinks this stock will fall even further. Plus, higher raw materials and energy costs weighing on Dow's sales outlook. The company's CEO joins us exclusively later on Closing Bell.
Shares of Intel lower after reporting a revenue miss and fourth quarter EPS guidance below estimates. The stock's down 7%. Here to break down whether that's an overreaction or not, Stacey Rascon, Bernstein Research. Stacey, it's a pretty good result compared to Snap. I kid, of course. Down 7%. Overreaction or not?
No, I don't think it's an overreaction. This does not look like a good print. I mean, the quarter itself was okay. Revenues were kind of in line. Margins were decent. The guide looks, but if you look under the surface, it's not great. PCs collapsed, especially notebooks. They actually missed on data center, which is sort of incredible when we're supposed to be sort of in the midst of a new product cycle. Data center margins are still lousy. The guide obviously was quite weak, especially on the bottom line, very low. There's a few other things. They actually pushed out the Analyst Day. The Analyst Day is people are waiting for this. This is in November. We were supposed to get color on what the actual sort of transition model going forward is going to look like. It looks like they pushed that out till February. They did say that they're going to give us some commentary on the call, so we'll see what they say. But they pushed sort of that very important Analyst Day out. The CFO is retiring. Like there's a lot going on here. No, I don't think this is an overreaction at all.
Is that a surprise, the CFO retiring? That's always sort of a red flag.
I don't know. I mean, George Davis has been around for a long time. You know, he was at AMAT and he was at Qualcomm and he was at Intel. So I don't know, but it probably doesn't help right now.
Is this going to set the tone for the sector, Stacey, going through earnings season, or do you think it's quite company specific?
Well, you know, the PC side, part of me is not surprised. I've been of the belief that PCs have been overheated and that CPUs, the stuff that they sell, have actually been overshipping by a wide margin. So we may be starting to see that correction. It's the data center piece of this that I would find like a little more broadly worrying if true. I'm just really surprised that they missed that number. They were light by probably 150 million versus kind of where my expectations were. And again, we had a data center digestion earlier in the year. Things were supposed to be getting materially better into the second half, and they were almost like flat sequentially. Their cloud revenues within data center looked like they were down 20% year over year. Like that's an astonishing number.
So is there any way to tell, Stacey, how much is the global chip shortage holding back some of this top line growth?
I don't know. I mean, certainly, you know, we are hearing of constraints in the PC space. I do not believe that those constraints have been CPUs. I think it's been other stuff. But like Micron a week or two ago sort of pointed to constraints in terms of like the systems themselves not getting built because they couldn't get parts. So it's part of it. But at the same time, it's also going to be a convenient excuse for many folks at this point in the cycle. We'll have to see how this plays out over the next several quarters.
Stacey Rascon, thanks for your first impression. Intel shares getting hit hard after hours. Are investors all in on stocks? Up next, Mike Santoli breaking down what the latest data on equity exposure means for the market. Plus, the fallout from Snap's ad warning is hitting other social media names pretty hard right now. Facebook and Twitter both down roughly 6% in after-hours trading. Snap down a little less than 25. It's come off the lows of the session, still getting hit pretty hard. We'll be right back. Welcome back. Time now for a CNBC News update with Shep Smith. Hi, Shep.
Hi, Sarah. From the news on CNBC, here's what's happening. The vote to hold former Trump advisor Steve Bannon in contempt of Congress approved just minutes ago on the House floor, with 9 Republicans voting with all Democrats. The case now to be referred to the Justice Department. Attorney General Merrick Garland will decide whether to prosecute. Bannon, of course, has refused to cooperate with Congress after he got a subpoena from the committee investigating the insurrection on January 6th. Are the remains found in Florida Brian Laundrie's? His family's attorney tells CNN the probability is strong. Investigators found them along with personal items that belonged to Brian Laundrie in a reserve near the family's home. 2 officials tell NBC News the remains include part of a human skull. And liftoff from a tiny island in South Korea as that country gets one step closer to having its own satellite in space. The good news here, South Korea's science minister says it hit the target altitude, but the bad news, the 3,000-pound dummy payload did not reach orbit. If eventually successful, South Korea would become the 10th nation to launch a satellite into orbit using its own technology. Tonight, we'll talk to a space lawyer about the courtroom battle between NASA and Jeff Bezos' Blue Origin. And we'll get live updates from Florida about Brian Laundrie on the news right after Jim Cramer, 7 Eastern, CNBC. Sarah, back to you.
All right, see you then, Shep. Thank you. Shep Smith. Let's go back to Mike Santoli now, who has been looking at investor positioning, Mike, as we hit an all-time high in the S&P.
Yeah, and some short-term traders, Sarah, have definitely chased this rally higher. This is a chart we look at once in a while, the National Association of Active Investment Managers, kind of market timers, tactical professional investors. They have kind of ramped their equity exposure back up to about 98%. Sometimes they go over 100%, which means they have leverage and they're long the market. And we were above those levels, as you can see right here, late 2020, early 2021, but still at the high end of the range. You can see how it acts at extremes as a slight contrarian indicator, although lows in exposure are a better buy signal than the highs are a immediate sell signal, just as context. Now, longer term investors, households, institutions of all sorts, pension funds, they have been running with a record high equity exposure. If you take a look at this asset allocation breakdown from Federal Reserve data, it's equities at about 52%. Now, this includes all financial assets, so there's some stuff beyond just stocks, bonds, and cash. But basically, we're at the or slightly above the 2000 highs. Maybe you could say for good reason, because when debt was that low in 2000, bond yields, risk-free bond yields were 5 and 6% as opposed to, between 1 and 2% right now. But it does show you that I think people are fully exposed. They don't have to buy anymore to rebuild longer-term allocations. It's maybe a general contextual headwind, if not a sell signal, but just as to in terms of where we sit right now with people's involvement in the market, guys.
Interesting, Mike, particularly as we close in another record high today. Yeah. It'd be interesting tomorrow, of course, with some of these tech names declining. Chemicals giant Dow, one of the worst performers in the SP 500 today, despite beating Wall Street profits and revenue estimates. Up next, CEO Jim Fitterling will join us to discuss those numbers and how he's dealing with the supply chain issues that so many companies are facing right now. Plus, much more on Snap's ad warning and whether this huge sell-off is a buying opportunity, as we're joined by another analyst as Snap declines 25%.
Dow shares ending the day in the red despite its Q3 earnings report, beating on both the top and bottom lines, forecasting Q4 revenue that topped analyst expectations. Dow CEO Jim Fitterling joins us now in a CNBC exclusive interview. Welcome back, Jim. Good to see you.
Good to see you, Sarah.
So not sure what you've heard about the stock making that mid-morning turnaround, but overall it looked like a pretty solid report in a tough environment. Talk to us about what you're seeing in some of the end markets that you operate in.
Well, as you said, triple beat. Top-line revenue was ahead of estimates. Second consecutive quarterly earnings record, and EPS ahead of target. So very good. And we guided up for the fourth quarter. Demand continues to be strong. I would say our only challenges this year have been two weather-related events, the freeze in the first quarter and Hurricane Ida in September, and that took out one of our assets in Louisiana. We've got everything running. St. Charles operations are back up and running, and we're looking forward to a good fourth quarter and getting our product availabilities back. And now we just have to work through some logistics constraints and some shipping issues. I don't think it's bad as what you see with inbound containers. But when it comes to trucking, the truck driver shortage does have an impact on products we ship by truck.
I feel like you're at the epicenter of so many of these big challenges that we talk about every day. And one thing analysts are wondering, Jim, is the interplay between costs and pricing. Looked like you had some very good pricing power. Is that going to continue? And what happens on the cost side?
Yeah, well, I think pricing power is a combination of things, but the main thing is demand has been so strong against a very tight supply backdrop, and we went into the weather events like Hurricane Ida with very tight inventories in all the chains. I don't really have a value chain right now that's not experiencing tight conditions, and that's primarily demand related. If you look downstream all the way to the brand owners, they're also tight on supply. So we need to get some stock back into all those value chains, and that's going to take some time. I did say on the call that I expected energy costs to be up quarter over quarter. That was really the only negative in the guide. Having said that, we have good feedstock flexibility and good position to try to mitigate those costs, and I do think higher operating rates will help offset some of it. But we go into winter, and we haven't really had a cold snap yet with some pretty high natural gas prices, and we're keeping an eye on that and getting ready to mitigate that.
Jim, I wanted to ask you about your recent op-ed arguing for market-based carbon emissions trading system to try and improve environmental outlook in the long term. I wonder why you think that's the right system and why you have confidence that it will work. It has been tried, particularly in Europe over the last decade or so. It's not like it's a resounding success.
Yeah, I think when you look at energy-intensive industries that are globally traded commodities, they have to worry about being competitive. And if you get yourself uncompetitive versus, say, the Middle East or China, essentially what you do is you drive investments away, but you also drive carbon leakage into those environments. When you create both a little bit of a carrot and a stick, where you have emissions allowances that reduce over time, but you have carbon prices that allow you to offset the higher costs, you have the ability to bring the financial markets in and really accelerate those investments. We announced the investment in Alberta for that reason. They have a carbon price today of $45 a ton, and they have an allowance scheme that reduces over time. And so we'll make an investment there. They have existing infrastructure for carbon capture. We think if we could get a system like that in place in the United States for hard-to-abate, energy-intensive sectors, that would drive us forward faster than a tax, which would be a revenue collection for the government, but not necessarily going back to solve the climate problem.
I'm looking at your stock performance, Jim. You've underperformed the market this year, up about 7% so far this year. Do you think you get credit for some of the sustainability initiatives that you're driving, like putting this idea out there? I know you've been front and center on the plastics issue as just a company that makes plastics and contributes to, or at least is thought to contribute to some of these problems. Do you think that holds back the performance given the focus on ESG right now?
Well, remember, we've come up from about $22 last year to well above 60 this year. But for this year, I agree with you. I think we're undervalued today. And I think the things that we've put out there are aggressive, but also they have near-term value creation in them. We have $600 million of productivity growth, both from digital and restructuring, that are being delivered right now. We have $2 billion of near-term EBITDA growth that's coming on starting next year and ratcheting up through 2025. And then the $1 billion of growth from the Alberta investment, which starts in 2027. So I think we've laid out a very compelling thesis for the investors. Our cash flow story is phenomenal. We've paid down another $1.1 billion in gross debt this quarter. We paid $518 million of dividend and $400 million of share buybacks back to investors. And we still have all of our liquidity and just a remarkable cash flow story. So we came out of this COVID pandemic with the best balance sheet in the industry, and we're poised to be able to lean into this and make investments that are accretive starting now.
Finally, Jim, I always like to get your view on the strength of the economic recovery that we've seen and just how much longer it can last. You touched so many different parts of it, from autos to beauty to infrastructure. What are you seeing out there about how much staying power this economic growth has?
The consumer is still strong. I still expect China next year to give us numbers, maybe 4.5% to 5% GDP growth next year. I still believe the U.S. consumer is going to be strong. We have Southeast Asia coming back. We have emerging growth in Africa. And I think Europe is going to see a better year next year. Automotive, even though we're talking about production being down and chip shortages, we will work through that. Inventory levels are at all-time lows in autos. So if you look at dealer inventories, 1 million units, I mean, we've got a huge restocking to do here, and production will come up as that semiconductor chip shortage starts to alleviate. Appliances are strong. I would say the biggest issue there is just getting them out the door and getting them delivered. But production is strong and demand is strong. We see it in all the consumer chains. The retailers all want more stock on the shelves to get their customer experience numbers up. So I think we're looking at a very good demand year for 2022. And in several of our chains, I think we've got a ridge between now and 26 that's going to be high operating rates, which is always good for our bottom line.
Jim Fitterling, great to talk to you as always. Thank you for joining us.
Thank you, Sarah. Thank you, Wilfred.
CEO of Dow.
Snap shares sinking after an ad warning, and some advertising stocks are also being dragged down alongside, as you can see there. But Snap, the big decline, down over 20%. We'll dig back into those numbers in more depth next. Snap shares falling sharply after reporting earnings, down now 23%. Let's bring in Brent Thill from Jefferies. Brent, talk us through why you think we're down quite so sharply.
Well, if they missed the number, so I mean, they clearly just absolutely missed their own forecast. And look, anytime a company puts out a 50% growth target, it's always comes back to bite them. But ultimately, I think this is IDFA combined with supply chain is what they called out. And IDFA is an issue that is an industry issue. It's not a Snap specific. So this is Facebook, Trade Desk, this is across the board that would have an issue. So ultimately, we think this is a great buying opportunity below 60. If this is, again, industry specific and not Snap, you know, everyone's going to feel the brunt of this in the short term, and this storm will go through and this will pass and these companies will come out of it.
So any reason to think it is Snap specific? I mentioned earlier the daily active users, which actually did look like a beat. 306 million. FactSet was at 301, higher than the last quarter, which was 293. Stephanie Link was saying maybe that was a miss. But is there any concern there? It's still more than 20% user growth.
No user growth issue, Sarah. It's all the ad-driven, you know, revenue number, right? So that really comes back to it's just going to take time for them to work through this. And we've heard this through our checks. Some of the checks going into the print were a little more skittish than we've heard in the past. And a lot of this too is supply chain. If you can't get a product to a consumer, why are you advertising? You're going to wait with the advertising to work. So I don't think this is Snap specific. This is a great company. They're innovating. They are definitely in the lead for the metaverse when we talk about the next generation of the internet. They have obviously become the de facto for the younger audience as they're venturing back out into the world. The map is under monetized. They have a video game platform. They have a broader dynamic ad platform. I mean, they have so many lanes of opportunity. So we don't think this is, again, these are one of these great opportunities where the stock's getting dislodged. And I think we'll look at and say, we'll look back a year from now under 60. This was a good opportunity.
I think he's calling it an overreaction.
He is indeed. Brent, thanks so much. Really interesting. Thanks. For joining us quickly. After the break, the Fed responding to widespread criticism over trading policy for its officials by banning its officials from trading. We've got Atlanta Fed President Bostic's take on that next.
Earlier this afternoon, the Federal Reserve announced it's banning officials from owning stocks. We caught up with Atlanta Fed President Raphael Bostic on the back of that news. Here's what he had to say about the decision.
We need to make sure that we do all we can to preserve and retain the public's trust. Over the last year and a half, we've done as a body things that we'd never done before, unprecedented interventions in the market to try to make sure that our economy got through this COVID crisis with as little damage as possible. But the rules didn't change. And so I think this is a step to reflect and acknowledge that the conditions have changed, our position in the market has changed, and we then need to change our approach to make sure that the public trust is kept.
Raphael Bostic, who also said that he didn't think there's any harm done or damage to the Fed's reputation. It does come at an awkward time, though, for the Federal Reserve. Fed Chair Powell's term ends in February. We'll see if the Biden administration reappoints him. And there are questions about the exit now. They're set to embark on this big taper, scale back of their stimulus starting next month.
Yeah, no, it's true. I think it is mostly an appearance issue as opposed to a genuine kind of profiteering insider information type thing, but it's obviously something that they absolutely had to act upon as opposed to just allow it to be voluntary or something.
It was never a corrupt profiteering thing. Yeah. It's just like you're in the body that has the most influence in a day and age where you've got to obviously make sure there's no conflicts.
No doubt about it. And, the renomination issue is certainly coming close, isn't it? I mean, we're in that window when you should expect it soon.
I just wonder how much market impact, because it is considered that the front runner, if Powell doesn't get the job, would be Lael Brainerd, and you wouldn't see a huge divergence. If anything, you might see a more dovish Fed chair. That's
true. What is interesting, though, is I've heard people say that when this period of uncertainty, when it's perceived perhaps that there's a lame duck chair, the committee can kind of go off and speak more freely or maybe kind of assert their own views a little bit more, which right now probably would mean a more hawkish message than the chair would be offering.
I don't know. We have Fed presidents on twice this week, and I didn't really sense that.
Well, maybe not, but they're certainly kind of untethered in their hawkish views, more incrementally anyway at this point. And look, the market, the yields are on a run right now. They're pricing maybe almost a third rate hike for next year.
Going to be tough, Mike, to have another record close tomorrow if Facebook's down 5 or 6%, Snap down 20.
Definitely a test because NASDAQ was the leader today, and that group is look like it's going to be under some pressure tomorrow. So we'll see if something can take its place.
Snap call will be one to listen into, as will Fast Money's analysis of whether this is an overreaction or not in Snap's shares down 25%. We're out of time here on Closing Bell. Thanks so much for watching. Fast Money now.
Live from the NASDAQ market site overlooking New York City's Times Square, this is Fast Money. I'm Melissa Lee. Tonight's trader lineup: Guy Adami, Tim Seymour, Karen Feinerman, and Pete Najarian, co-founder of MarketRebellion.com. We kick things off with a major earnings alert on Snap. That stock is plummeting after our shares are now down about 23%. The call is just getting underway. Let's get straight to Julia Borson with more on the quarter. Julia.
Well, Melissa, that stock is plummeting after Snap reported third quarter revenue that missed estimates. And the company, most importantly, I think this is really what the issue is here, it guided to lower than expected revenue for the fourth quarter. Now, Snap did beat on daily active users. It added 13 million over the course of the quarter for a total of 306 million daily active users in the quarter. That beat estimates by about 4 million. But Snap CEO Evan Spiegel warning in his prepared remarks that Apple's iOS privacy changes are impacting the company more than anticipated, saying, quote, while we anticipated some degree of business disruption, the new Apple provided measurement solution did not scale as we had expected, making it more difficult for our advertising partners to measure and manage their ad campaigns for iOS. Now, Spiegel goes on to say that the company is working on building its own first-party data measurement tools to help mitigate the impact of these Apple privacy changes. The company also noting that supply chain constraints and labor shortages are hurting its advertisers, and in turn, that is impacting Snap's business. Now, take a look at some of the other social names that are taking a hit on this news. Now, along with Snap, Facebook, Twitter, Pinterest, and Google parent Alphabet are all trading lower. Of course, Melissa, these results from Snap raise questions about whether we will see similar impact for these other social stocks that are so exposed to advertising in that iOS ecosystem, Melissa.
And Julia, remind us, I mean, it was just a month ago or so that Facebook, correct, had a blog post about that, what they anticipate this impact would be, and investors wanted to sort of look through that and look at what we have right now. I mean, the reaction is you know, the ripple effect across the sector is just really notable.
Yeah, really notable. So I think, Melissa, what Facebook warned about was exactly this. It was a measurement issue. If they can't accurately measure, it makes it very, very challenging for advertisers. And so Snap had taken a slightly different approach than Facebook. Snap had said, we're going to be working with Apple and their measurement system. We think that that's going to work out. Turns out that that's not accurate enough, and that's why Snap is now shifting gears and building its own first-party data and measurement system. So I think, you know, Facebook did handle this differently, but I think that that warning, that blog post a couple weeks ago, was indicating that we could see some impact like this. But Melissa, it's just, this is an unfamiliar area. It's new territory for all of these companies. They're trying to navigate it. It's not just a question of can their ads work in the Apple ecosystem, it's can they measure how well they work? And that's the key piece that we're seeing right here.
All right, Julia, keep us posted on this one. Julia Boorstin, the latest on Snap. Guy, what do you make of this?
This might come back to bite me in the rear end, but I'll say this. Look, Snap was expensive going in, but a lot of people still love the stock. I mean, Goldman Sachs, I think on September 13th, initiated with a $90 price target. And oh, by the way, when you parse through the numbers, they still had 57% year-over-year revenue growth. So pretty astronomical numbers. Okay, but I get it. Valuation is a concern. They whacked the stock. But Facebook down here, in my opinion, is a bit of a gift. Because if Facebook didn't warn already on the back of this, given all the things that they've been going through, you got to believe that the quarter on Monday is going to be stellar. So Snap is a valuation concern. Facebook at these levels is trading at 20 times next year's numbers. I think you got to buy the stock. I couldn't figure out what the stock looked like into earnings, given the run that it's had over the last week or so. But I think the setup now looks really compelling into earnings on Monday, in my opinion.
Why shouldn't Facebook investors, Karen, be concerned about what Snap is saying? I mean, the CFO had already said in the previous earnings conference call that the bigger impact would be in the third quarter. They talked about it in the blog post. We're getting confirmation from Snap that there was a big impact in the third quarter. And so are you worried, Karen?
Well, I'm always worried about everything. It's just sort of my nature. But as a Facebook holder and an Alphabet holder, I am worried about this, but Facebook is down a lot. Remember, they had all kinds of, you know, a crescendo of negative news between the whistleblower and the outage and all of that. So the stock has come in. To Guy's point, this valuation issue isn't one that can't be ignored. Snap had a much, much higher valuation due to its higher growth. So when you miss and you have a super high valuation, you're going to get punished more. So I don't know if this is enough of a punishment for Facebook and Alphabet, but it does set up better going into earnings, having been down. And they've already sort of addressed this. I don't know if this is the kind of thing, if we get a really bad tape on the day that Facebook announces if it's going to trade down again on the exact same news, which is this, if the effects of the Apple privacy changes. I don't know. But to me, ultimately, it comes down to valuation. When you back out the cash from Facebook, it's not even close. One other thing that's sort of interesting is for PayPal, which has just gotten crushed on the idea of maybe they're going to buy Pinterest. This just sort of adds more cold water for some investors who don't want PayPal to do that. Pinterest trading down. So it'll be interesting to see how the whole industry shakes out. I think Facebook and Alphabet will hold up the best.
Yeah. Tim?
Well, who needs crypto when you could have owned Snap from pre-COVID levels? I mean, stock's up 400%. Everybody's focused here on the very important, the most important issue is this is a stock that's 23 times 2022 revenues, 23 times sales. I mean, that's crazy. And so I think the whole Apple iOS ad campaign measurement issue is an issue for all of these players, but it affects them all, you know, proportionally the same way. And it's a macro issue. It is what it is. It doesn't necessarily change what the underlying business was. I do think advertisers have a more difficult problem. And then there's companies in the tech space that absolutely, this is what they do for a living. And I think this serves them actually quite well. But I think interesting also to hear about supply chain dynamics also affecting the ad campaigns. And that was something we hadn't heard from other people as well. Yeah. So to me, this is a Snap issue on valuation, even though these are headlines that we've been reading from all of them on the iOS headwinds.
I mean, it makes total sense, right? But yeah, when I read it, I was like, oh yeah, that's something I really hadn't thought about, Pete. And that is, you know, the supply chain issues impacting their advertisers, which is then impacting advertising with Snap, which is another headwind that Snap faced.
Yeah, absolutely. And they promised so much as well, Mel. I mean, if you go back and look and see what they were projecting for this quarter, it was astronomical, and it made it very difficult. And you guys are all talking about, I think, the right things, which is when you look at this from a valuation perspective and you look at the PE or whatever metric you want to look at for Snap versus a Facebook, for instance, it's not even close. And the cash that Facebook is able to generate is unbelievable. They trade in the 20s in terms of the PE. So there's a lot of differences between these companies. I realize they're both in the social world, but one of them certainly separates itself from the others when you look at balance sheets. There's no doubt about it. Growth is an issue, and when they actually projected some of the growth for next quarter as well, that didn't look so great. So I think there's a lot of different reasons why right now Snap is in the penalty box. Snap is definitely getting hammered today, obviously down 20+%. But I look over at Facebook, and just last week, I actually bought a little bit more stock in there, not calls. I bought stock on that pullback. I probably will be reevaluating and looking at that again to possibly look to maybe add more stock on this pullback, because I just think it's far too cheap, and I think Facebook is so much better run, and they're so much more mature right now. I think Facebook has a great chance for a snapback.
To Karen and Pete's point, Guy, I mean, it is a better setup going into earnings for the rest of this group to trade down lower on this issue, as opposed to trade down lower when they actually report. At the same time, you know, when they reported and on the Snap call, I would think that investors still want clarity on when the bulk of the impact will be felt of this iOS change. And if the companies can't give clarity on that, then it's sort of an open-ended question that's hard to deal with.
Clarity in terms of this, I think the best, probably, this is just my opinion, I think the company best suited to give clarity would be Facebook, you would imagine. But, you know, I could be 100% wrong on this. But I think in terms of what we've all talked about, clarity comes in many different forms. You get bang for lack of clarity when you're trading at the valuation that Snap was trading at. I think you get the benefit of the doubt at the valuation Facebook's trading at. So, listen, I understand why all these stocks are down. We didn't even talk about Google, which, by the way, is probably lower as well. I haven't looked. But, you know, just in terms of valuation and the setup into earnings, again, I was sort of apprehensive about Facebook, given the big sell-off, the subsequent bounce. I didn't know what to make of it. I think I'm a little clearer now into how it sets up into Monday. Now, we could do the show on Monday night, and you could start by fricasseeing me, and that would be fine because it's happened before. But, you know, we try to get ahead of things on this show, and I think the sell-off in Facebook, to me, gives you a buying opportunity into earnings a couple days from now.
Let's get more on Snap with Jefferies tech sector specialist, Jared Weisfeld. Jared, great to see you. What's your take on this move in Snap?
So I agree with what everyone's been saying. I think everything needs to be put in perspective in terms of expectations and trying to frame IDFA, which is the Apple privacy change that clearly impacted the business more than expected in the quarter. You know, for the last 6 quarters, Snap has been beating revenue by about 10%. And here we walked into not only something that's not in line, but obviously a straight out miss versus the street. They grew revenue by about 50%, 57% year on year, which is obviously a staggering number. But, you know, buy side and investors were looking for something closer to 70% year on year growth. So clearly an expectations miss there, driven by the Apple privacy changes. Underneath the surface, you have the engagement trends, which are certainly positive, right? When you look at daily active users, DAUs, those nicely beat for the quarter at 306 million, 4 million ahead of the street. Their guidance that they gave on the conference call coming in ahead of the street at the forward quarter. So it's not a user problem, but it goes back to the fact that they're having a significant problem trying to go ahead and be as effective with their ads in the context of an IDFA world. And that's really taking its toll on the growth rate. So, you know, this is not idiosyncratic to Snapchat. Anyone within the ad tech ecosystem is clearly going to be impacted here. But, you know, when you look at Snap trading at, you know, north of 20 times revenue, which is an 8 to 9 point premium where it's been trading versus the last 3 years, you know, clearly a big reset ahead for sure.
Jared, I got a quick question for you. So based upon what you're talking about, it sounds like you're viewing this the same way we are, but I just want to hear confirmation on that. How about Facebook? What are you looking forward to come Monday in terms of Facebook after what we've heard just now this evening?
Yeah, no, I think all the points that have been made have been spot on. And I think from a Facebook perspective, when you look at the relative valuations, you know, Facebook is trading at 10 times next year EBITDA. not revenue, EBITDA, right? It's an incredibly profitable company. And if you look at where expectations are into 2022, the street already has revenue estimates getting cut in half. You're going from 40% year-on-year growth in calendar 2021 down to 20 into next year. So it's similar to what Guy was saying in terms of it's almost a free look at the Facebook print with an improved setup in the context of revenue estimates that are more than reasonable in a stock that's trading probably after tonight low single or high single digits as a multiple of 2022 EBITDA.
Hey, Jared, Tim, so let's look at some of the secular trends, though, around ad pricing, around the environment for digital ad, which has been such a strong story. Facebook's ad price growth, over 40%. Part of the reason why the stock broke out. What do you take from Snap's headlines on global supply chain yet again, and what this means, though, for medium-term pricing? It's one thing, we get through this period, but isn't the tailwind still very much intact?
I do think the tailwinds are intact. I mean, we're going through something that is potentially transitory in terms of just an IDFA reset and what that means from a pricing standpoint. But you think about the walled gardens, you think about the platforms that are being created at Facebook and Apple and Google. Very similar to what happened to GDPR, the privacy standards from 3-4 years ago. The larger you are, the better position you're going to be in, right? Scale to get scale. So I think it puts them in an improved position. The one wild card that you have to think about from a cyclical standpoint is exactly what you talked about, Tim, in terms of Snap highlighting global supply chains are an absolute mess, right? So does that impact their advertisers? You're lapping unemployment benefits that were enhanced. So is the consumer potentially more impacted than not? So you do have potentially some headwinds within the overall digital advertising spend environment to think about. And the implications are obviously significant when you think about what to own within tech. Do we just see a rotation more into software because you've got a big chunk of internet that's potentially offline to many investors?
Jared, can we talk a little bit more about the reset because of these new privacy rules? I mean, how should investors look at it? I like the idea of thinking about it as a rule change that everybody has to contend with, and so it affects all of these players. But once we get to the so-called other side of this, what does that world look like in terms of ad rates? Because it's less targeted and the information is not as good, do ad rates come down? I mean, how should investors think about that?
So I think that's exactly right. So we're going through this reset. Ad rates are coming down. You have to believe that the likes of Snap, the likes of Facebook, those large established players that have those large R&D budgets. It's amazing that Facebook is still trading at 10 times EBITDA in the context of, they're going to spend $90 to $95 billion next year from a cost standpoint in terms of all of the OpEx plus cost of goods. I mean, they're pouring so many billions of dollars into this. So clearly they're going to do what they can in terms of just to increase efficacy of these ads. So longer term, I think you have to believe that they're working on a solution from that standpoint. But, there are other alternatives to think about, right? Do you have advertisers that shift dollars away from Facebook, away from Snap, to the likes of, whether it's a Unity or an AppLovin or an IronSource? Do those names potentially benefit from an advertiser shift perspective because there's just such a difficult time from a targeting standpoint? But, this does level the playing field across the board. Everyone is facing these headwinds, and it's not just a Snapchat problem.
So it can't necessarily be assumed that things go back to normal after this reset. That's what it sounds like. There's a possibility that there's a shift.
Absolutely. Unless Apple backs down, and that's not something I'm expecting. Tim Cook has been so adamant that privacy is something that he takes so seriously from a corporate standpoint. If that's going to be their stance, then that's a headwind for the entire group for sure.
Jared, always great to get your perspective. Thank you.
Thank you, Melissa.
Jared Weisfeld of Jefferies. Karen, how do you think about this reset, as Jared put it?
Well, the one thing he talked about, which I think others have as well, is the ability of Facebook and a Google to navigate this maybe better than Snap, better than some others. That'll be really interesting to see. However, I mean, I'm optimistic that they'll be able to do it. I don't know if, even if they are able to do it, it still hangs over these stocks and puts somewhat of a ceiling on them. I don't know. It's not making me a seller at all of Facebook or Alphabet. I saw it down maybe 3% or so, which probably isn't down enough going into earnings, but I'm not a seller. I think they'll navigate it better than most.
Something that we haven't talked about yet is the impact on the tech sector. I mean, we're talking about some of the biggest names getting whacked in the after-hour session, as Guy would like to say. And the impact tomorrow has got to be a negative one on the broader markets, Guy.
You know, it's interesting. I mean, it's when you can see stocks of this magnitude. Obviously, we're talking about Facebook, the market cap there, Google. When you see 2, 3, 4% moves in names of that magnitude, it makes you wonder, you know, if it can happen to individual names like that, what could happen to the broader market? We obviously haven't seen a single-day move of really any significance for quite some time. It just sort of, I think it sort of reminds us that this could happen. It's going to be fascinating to see how the broader market trades tomorrow, right? I mean, we've seen news, not necessarily of this magnitude over the last year and a half, that's been sort of brushed off by the broader market over a day or two. I mean, tomorrow's going to be interesting. Again, I think personally, this is, again, just my opinion, it seems like pretty Snap specific in terms of the move. They went public, I think, in September 2016. I remember the first conference call was a disaster, but they were great ever since. This is really their first big misstep since. But I want to give it Snap specific unless Facebook proves me wrong on Monday, which I don't think they will do.
Right. I mean, the runway for this market move is now until Facebook reports effectively, Tim. But we're also talking about this part of the tech sector that it's getting whacked in the context of rising rates, with the 10-year at 1.7% right now. So that doesn't help either. I mean, you're really taking a hard look at not just the sector itself, but the context in which the sector is trading.
But you know, Google and Facebook being value plays, quote unquote, in the middle of this sector, I think should make them more immune. No question. Yes, we talked about mega cap tech stocks being very defensive in a low rate environment and lower growth environment. If yields are moving higher for a couple different reasons, that could also be ultimately good for the economy. That's not necessarily good for mega cap tech because of the allocation. I think the most important thing is where we've come from. And triple Qs, NASDAQ 100. So Google and Facebook make about 8% of that. And we know that the top end is really Apple, Amazon, and Microsoft. But that up 4.5% over the last 5 days. A VIX sub 16. I mean, these are the reasons why I think tactically traders should be paying attention going into that big week of mega cap tech earnings. They've had a big run. This seasonal pressure is something that really almost seems like a distant memory. And I think that's the most important issue right now.
Seeing the moves that we are seeing in the after hours, Pete, what is the thing that you buy tomorrow or maybe tonight in the after hours?
Yeah, well, most intriguing to me after just what we were all just talking about is Facebook. I had already reached in there once, and it had a nice run up towards 344. Then it pulled back, and now here it is once again in the 320s. I think that creates another opportunity that I'll probably be looking at. I realize that obviously there are some dangers out into the future, but here's the amazing thing. With this big pullback that we've seen out of Facebook, right? I mean, pretty significant, and a little bit of a recovery, a little bit off of the lows. We're up 1,000 points over the last couple weeks in the NASDAQ itself. That's pretty impressive. I mean, no matter how you slice it. So there's a lot going on, Mel, and even with the rates where they are, as you mentioned, and yet you're still seeing the NASDAQ stocks, which are the ones that are supposed to be under a little bit of pressure when we see the 10-year starting to move to the upside. It just shows you how powerful this move really is. And it is Microsoft. It's all the names that Tim was just talking about, these big mega cap names that I think are still names that we all should own, because not only do they look great on a valuation basis, they're still growing. They're growth stocks as well. So I think that combination tells me that I still think there's room to the upside for a lot of these NASDAQ names.
All right, coming up, we are all over the after hours action. In Intel, the stock is sinking after reporting its results. The call is underway right now. The details are next. And later, a retail runaway. One top analyst says a Macy's e-commerce spinoff could be worth $42 a share. We'll press him on that call in just a few. Fast Money's back right after this. Welcome back to Fast Money. We've got an earnings alert on Intel. Shares of the chip maker are down by about 8% in the after hours on results. Let's get to Josh Lipton for the details. Josh.
So, Melissa, heading into this report, Intel was up about 10% this year. It was down about 20% from its 52-week high, but now, as you noted, headed sharply lower here. As for the report, beat on the bottom, light on the top. Q4 guidance, 90 cents versus an expectations of $1.01, 18.3 billion versus an expectation of 18.25 billion. I caught up with Matt Bryson over at Wedbush. He says Q3 EPS was strong, but that data center business wasn't as strong as expected. Q4 guidance, Matt says, EPS was light, gross margins coming down, OPEX going up, suggesting costs will be higher next year. Questions on the call from Matt. Where is Intel on its product roadmap, and what does this company's gross margins trajectory really look like? CEO Pat Gelsinger on the call just now saying Q3 was solid. Demand for semiconductors is strong, but this is a challenging supply environment, he says. He told CNBC's Kif Leswing that he didn't expect the semiconductor shortage to really end until 2023. As for the data center, says that he's confident in its long-term strength too, but there are short-term supply constraints impacting that business as well. For more on Intel, by the way, be sure to tune in tomorrow morning. Our own John Fort on Tech Check speaking with Intel CEO Pat Gelsinger about this report. Melissa, back to you.
A lot of questions we've got. Josh, thank you. Josh Lipton on Intel's quarter. Tim Seymour, what do you make of it? I mean, it seems like everything was going in the wrong direction for Intel, and the culprit is supply chain, according to the CEO.
Yeah, so, should they be hit harder than others? And, maybe, because I think people think that Intel has so much still to prove to, invest in their foundry business, to be a global player in the strategic dynamic on the equipment spend and ultimately where their interface is. Look, it was going to be a 2 or 3 year process. In that sense, you could say, give them some time. But we want to hear about the CapEx spend. We want to hear about the commitment here to the foundry business that puts them in a position at some point to take the control of pricing for the sector away from Taiwan Semi, et cetera. But look, disappointing on the guide doesn't really change where the stock sits and why it trades at the multiple it does, which is significantly cheaper to Taiwan Semi and other comparable players in the space. And that's because we've digested this story before. Data center group growing 10%, not good enough. And really 2 quarters ago, that was what knocked this stock out of bed.
Value trade or value trap, Pete?
I'm starting to feel like it's more of a value trap, Mel. I mean, the stock itself actually had a pretty decent run until this huge pullback that we're seeing now. But it is frustrating. I know Tim's probably frustrated with this. I think you're in this, Tim. I'm in this stock.
Yep.
And I got to tell you, my frustration is very high when I'm looking at something like the conversation about constraints. We all understand that. We know we're going to hear that. But it just feels so terrible because I got a feeling as we hear others in the industry, I think we're going to hear some different numbers. We'll see, I guess, whether or not it's NVIDIA or AMD or whomever. But it is frustrating, Mel, because unfortunately, I thought this CEO really had a handle on things and was ready to press forward. And when I look at those data center numbers and when I look at the projected earnings numbers, it's frustrating because they just aren't there. And they're not there yet. There's still a lot of spending that has to go into this. And that's going to be taking a lot of the money that they get. And they've got great free cash flow. We know that. But the frustration level is getting high because this is a stock that continually goes 1 step forward, 2 steps back. And here we are once again back towards the low 50s.
Guy, do you think Intel sets the tone for the sector, or do you think that hearing the other reports will prove that Intel has its own problems unique to Intel?
I think this is Intel specific. It's been, you have other companies that are flourishing. I mean, AMD and NVIDIA partnering up. I mean, there are a lot of really good things going on for a lot of other people. By the way, Texas Instruments, which I didn't really understand on valuation $15 ago, continues to grind higher. So there are clearly some winners. This happens to be one of the losers. I get data centers should be growing more than it is, but it wasn't a complete disaster. And, oh, by the way, if you look at some of these other names, client computing was fine. The revenues came in a beat. And, oh, by the way, one other thing, operating margins were better than the street was expecting at 28.5%, down year over year, but still decent. They took this stock out to the woodshed on the back of this, which to me is pretty surprising. But I think what people are saying was, you know what, Intel's got to prove themselves now, and they haven't been able to do it.
All right, coming up, attention mall shoppers. We've got a big call on Macy's. One top analyst says it could be a $42 stock. Could tell us how he gets there. Plus, a Trump-backed SPAC going off the charts today, surging more than 300%. The company striking a deal to launch the former president's social media platform. Could this shake up the entire media space? You're watching Fast Money live from the NASDAQ market site in Times Square. Back right after this. Welcome back to Fast Money. Macy's shares ripping 13% in the past week. This comes as speculation heats up over a potential spin-off of its digital business. Cowen boosting its Macy's price target to $32 from $27 a share. And if an e-commerce spin-off becomes a reality, the firm sees the stock going even higher. Oliver Chen is Cowen's senior retail analyst. Oliver, great to have you with us.
Great being here, Melissa. Thanks for having me.
Are you basically saying that after the spin-off, Macy's, the brick and mortar part of the business, will be worth much, much more?
Yeah, Melissa, the e-commerce business is worth as much as 1 to 2 times sales or more. That yields a stock price of $40 plus. We don't necessarily think a spinoff is imminent. However, our note really lays out these different scenarios in which the e-commerce business is very undervalued relative to how Macy's is trading currently. So Macy's is trading overall at 0.5 times sales. As we look at e-commerce businesses and comparable companies, they trade at 1 or more times sales multiples. So this is entirely possible and is being analyzed. However, there are a lot of risk factors, and separating the two businesses will not be easy. They will have to go over hundreds of service agreements as well. Customer acquisition occurs across both channels. And clearly the customer's omni-channel, behaving and shopping in both digital and physical.
And thanks for coming on. I'm sort of confused. Is it possible that the rest of Macy's, with the debt, with the bricks and mortar, and maybe some of them under scale, is actually worth negative depending on how they divide up the e-commerce sales?
Yeah, that is part of the interesting story here, because the rest of the business, the physical side of the business, we model at declining 3 to 4%. And at the same time, we model the digital business growing 9 to 11%. So thinking about a sum of parts, clearly a valuation will be lower on a negative business, but it's also a little bit of art and science in splitting these two businesses up, because As you know, a physical presence really helps you acquire stores online. Furthermore, you're shipping from store, buy online, pick up in store, and the customer experience occurs across both channels. Another side point is Macy's does have valuable real estate. We've quantified that at $2 billion. It's generating $1 billion of cash flow. So the question is, can Macy's achieve this valuation, this e-com valuation over time itself without this deal happening?
So, Oliver, you know, what's puzzling to me as a layperson looking at the situation is that you have part of the business, the e-commerce business, which is worth much, much more. And then you have the bricks and mortar part of the business, which is sort of like a shrinking ice cube without any e-commerce unit. And so you have these two moving parts, and when you put them together, I don't really understand how, in the end, value is created much more than where it is right now. Are markets that inefficient that we're really not recognizing the extreme valuation gap between the bricks and mortar and the e-commerce?
Well, it's a bit of a journey, Melissa, and that's one reason we upgraded Macy's stock, because we think on an overall basis, the valuation multiple, the free cash flow generation, it's an attractive idea. The market is skeptical. I mean, the multiple of Macy's being 7 to 8 times PE, it's very low, and it's not getting a digital multiple, which is 1 to 2 times sales. So it's TBD in terms of conviction and what the company can do. Our overall thesis calls for the digitization of Macy's, and Macy's really acting with speed and more like an e-commerce retailer. This is an interesting question. Can you and should you separate the two? Part of this is time horizon, part of this is execution, and part of this is really understanding, you know, what kind of decisions you'd have to make, which would be quite complex in splitting businesses. The future of retail, in our opinion, is physical plus digital. Can you separate them? Should you separate them? It's a short-term versus long-term decision as well.
Oliver, thank you. Oliver Chen
Great being here
of Cowen. Tim, I'll go to you. I mean, it does seem like an extremely complicated relationship to sort of extricate. I mean, if you have, for instance, a sale that's made in online and then brought to the store, I mean, presumably there would have to be, Oliver mentioned, service agreements, because that store is going to send back the merchandise for the online to process. I mean, it's complicated. It's not. This is not an easy thing to do.
And that's what that Oliver's pointing out, and I don't think he's suggesting that it should happen. In fact, it's that complementary nature of the hybrid multiple that you want to see Macy's get, which is, look at what Walmart's doing. That is core to a thesis I have on a long position in Walmart. Or how about Target? Give Oliver credit, by the way. He didn't just upgrade this stock today or yesterday. He's been upgrading this stock. He upgraded the stock 6 or 8 weeks ago. And you know, he was pointing out that digital penetration is going to be 42, 43% out in a couple of years. So talking about this core business. So a lot of folks have gotten excited about Macy's. But you know, I do think that this call is something that he's had out there for a while. And part of it is also just a sum of the parts, and looking at $7 a share on real estate, and looking at a dividend that no one thought that they could pay. So that dividend yield is actually something you don't buy the stock for, but it's certainly something that protects your downside.
Guy, quick on Macy's.
It's interesting. I think in summer 2018, it was a $40 stock. I mean, I don't think it gets there, and Pete probably knows this a lot better than I do, but this sounds like one that if you're getting paid enough to sell upside calls against an existing position, you do it all day long. I think if this gets to 32, which is the price target you just mentioned, I think you take the money and run.
Coming up, a Trump-backed SPAC surging more than 300% today. The company striking a deal to launch the former president's social media platform. So what could this mean for the media landscape? We're breaking it down in just a few, and we're continuing to watch shares of Snap in the after-hour session. The stock is still down about 23%. The company's call is underway. We are dialed in. We'll bring you any big news that comes out. Back right after this. Welcome back to Fast Money. Whirlpool out with its third quarter earnings. Seema Modi joins us now. Seema.
Hey, Melissa, Whirlpool shares are falling in extended trade as the appliance maker deals with supply chain issues. That led to the company's biggest revenue miss since April of 2009. Now, in North America, Whirlpool says constraints remain elevated across the entire supply chain. Net sales rising just 5%, driven by price increases. It did see strength in Latin America, specifically Mexico, but Asia, wow, very weak. Net sales dropping 21% in the third quarter compared to the same period a year ago following the divestiture of Whirlpool China. Now, the company still referencing strength in the housing market and continued use of appliances driven by more consumers cooking as a big driver of the overall business. In the past, Whirlpool has managed to raise prices to offset higher raw material costs from steel to resin. The question is, of course, going forward, is the ongoing supply chain constraints make it much more difficult to do so. We're looking at shares of Whirlpool now down as much as 22% from its 52-week high. Mel?
All right, Seema, thanks. Seema Modi. Tim, I'll go to you as a shareholder. What do you make of the quarter?
Well, it's a case where supply constraints and all these dynamics are things we know. The higher input costs, I think the question you have to ask are some of these trends around demand things that are really well understood or investors have belief in. Their international business, I think, is underappreciated. And again, some of the growth trends there. Look, I think the valuation here makes this stock highly compelling. And I think we talk about this housing trade all the time. We talk about going through home builders in more traditional ways, very difficult and not necessarily a real read on where people are investing in their homes. I think Whirlpool's, let's put it this way, the tailwinds around these trends are very much in Whirlpool's favors. Can they get their margins intact? I think they can.
Yeah, I mean, the margins are the big question because, as Seema mentioned, they've already raised prices, Karen. So how do you think about that?
I think they still have some pricing power. They were able to do it before. You know, I come to this question that we always ask, is a dishwasher delayed, a dishwasher denied, or a washing machine? I think probably not. I'll be interested. I like to hear the call. So that'll be tomorrow morning at 8. I want to hear what kind of sort of what could they, had supply chain issues not been present, what could they have delivered? That'll be important. And I think, look, the stocks come in a lot. So some of that was on a little pullback in housing. It's some of that, I think, was on supply chain. So to me, it's sort of trading down on the same news again. I'm long. I like it. But I do want to hear the call. I want to hear how what their outlook is and whether they're seeing any demand issues from housing.
Pete, your quick take?
Yeah, I just look at this stock and it's way too cheap. I think, you know, everything that everybody else has talked about just now, but it was a $260 stock, and here we are now down significantly off of that. It trades at a very low multiple. I think there's a lot of reasons, 10% short on the float. A lot of reasons, Mel, I think that I would like to sniff around as well and maybe even start a position on in here, but it will have to come after if I hear something about demand. I want to make sure there is still the demand for their products.
All right, coming up, a Trump-linked SPAC surging in today's session. The big money details next. Welcome back to Fast Money. Check out shares of Digital World Acquisition Corp. The SPAC soaring more than 350% after striking a deal to take former President Donald Trump's new media company public. The Trump Media and Technology Group plans to launch a social media app called Truth Social. The former president says he is launching the platform to, quote, stand up to the tyranny of big tech. Donald Trump has been banned by social media giants Twitter and Facebook since early this year after he was accused of inciting the January 6th Capitol riot. Karen, you've been digging into the details. You have a position. You had a position today. What's the status?
Yeah, I know that sounds shocking. So SPACs are sort of a somewhat misunderstood kind of entity, and the warrants that traded with this SPAC to me seemed ridiculously underpriced. I cannot understand why someone would not buy the warrant, which has an 11.50 strike price, now it's trading up to 15, versus the stock, which is now 57, which is about $10 higher than before we started this show. And the combined entity isn't $1.8 billion, which is what the SPAC looks like. That's only the SPAC's portion. The combined entity is now like closer to $10 billion. So that's pretty great valuation out of something that doesn't quite exist yet. So I don't know what happened to make this thing just take off, but it is interesting. I do think that there is an audience for it. So this will be potentially a decent competitor. If I were Fox News, I'd be a little bit concerned. I don't know how he's going to be coming at Twitter, but there's sort of something there. To me, it was just a complete mispricing. I think people don't understand how the warrants work. It's kind of crazy though. 10 billion out of nothing. We'll see what the business actually looks like. Nobody's seen it yet. We don't know. The prospectus isn't out yet, so nobody has any details.
And by the way, there's a Reddit component to all of this because this is one of the most mentioned tickers today on Wall Street Bets, even exceeding GameStop at one point, guys. So there are a lot of layers to this story on top of whether or not this could actually be a player in the social media space.
That is the story to me. This could be the meme stock we talk about now for the next few months without question. So as Karen mentioned, I think it has a 57 handle now. Again, knowing nothing whatsoever about the company. I mean, we've seen it enough times in other stocks to see what can happen when the masses get behind something. So I think you sell this. Again, I said at your own peril last night. We were talking about, or Wednesday night, about MicroStrategies. I'll say the same thing here. This could do very odd things over the next couple of weeks, so strap in.
Coming up, shares of Tilray blazing higher this week, and options traders are betting on even more green ahead. That trade is next. Don't go anywhere. We're live at the Nasdaq market site in Times Square. Back right after this. Welcome back. We are all over the after-hours action in Snap. The stock is off its after-hours low, still down by about 22%. Let's get back to Julia Borson with some color from the call. Julia.
Well, Melissa, the first 35 minutes of the call was the company reading its prepared remarks. Now they're in the Q&A period. The first question was a very long one, a very long answer from Evan Spiegel. He described the situation as a frustrating setback. He said this has been a frustrating setback, but over the long term, they're investing to create solutions that will help them better serve their advertisers over the long term. So he's trying to focus on the solutions and how different their systems will be. And he does detail some of the ways that relying on Apple's measurement of the impact of their ads just wasn't sufficient, trying to find solutions to that right now. But we see Snap shares still off more than 21%, Melissa.
All right, Julia, thank you, Julia Borson. And what Julia was mentioning, Guy, was this notion that some of the bigger players might be better positioned to deal with the changes in terms of having the money to spend to figure out new tools to measure better.
That's always been the case, right? I mean, the names like Facebook, I mean, as much as people want to shoot against them on the back of these things, they're the best equipped to take some of the arrows that are shot their way. So I think that's what we're all saying at the top of the show. This, to me, just reinforces some of the points we made earlier.
Yeah. Karen?
Yeah, I agree with Guy, agreeing with me, agreeing with him earlier at the beginning of the show. I do think it did sound very specific, and I think Google as well has the tools to do it. So if they're down a lot going into earnings, that could set up nicely, as Guy is pointing out, for Monday.
Yep. Checkout shares of Tilray, meantime, burning higher this week. The pot stock is up nearly 13%, and options traders are betting this burn continues. Mike joins us to break down the action. Mike.
Hi, Melissa. Yes, on Tilray, we saw more than 2 times the average daily call volume. This typically does trade fairly heavy options volumes, and calls outpaced puts by more than 6 to 1. Although I should mention that over the last 20 days, it has averaged more than 4 to 1. So quite a lot of bullish activity. The most active options were the 12-strike calls that expire tomorrow, but we also were seeing some activity in those that expire at the end of next week. Over 12,500 of the 12-strike weeklies that expire next week traded for about 57 cents. Buyers of those calls are betting that Tilray could rally 9% plus over the next week.
Tim, I know you noticed this move, and you are, by the way, at a cannabis conference in Vegas.
I am. No, I'm out at MJ Biz. This is the annual industry event, and all the exciting things that we talk about in cannabis, growth, M&A, and whatnot. And in Tilray's case, the stock actually to the intraday highs today was up 21% over 3 days on massive volume. And so, again, people have been critical of some of the Canadian LPs, rightly in some sense. But if you think about a price to sales multiple, which I think makes a lot of sense in cannabis, because the companies, even the ones that are in the U.S. that are profitable, aren't really profitable in the current tax regime. And so about 8 times sales is a big position in my cannabis ETF. I think they're a company that will be there. Irwin Simon at the helm, I think there's a strong brand story there. But for cannabis overall, it's been a very difficult 6 months, which belies this growth opportunity. But you wouldn't know that in Vegas. It is game on out here, and it's a pretty exciting time.
It's so exciting that you're wearing a T-shirt underneath your blazer.
Well, it's my Vegas. It's kind of what. Well, it's a purple T-shirt, and I'm wearing that intentionally. But I mean, this is, if I was in Miami, it would be like my Don Johnson look. This is my Vegas look. Vegas, Mel. Vegas.
Vegas, baby. All right, thanks, Mike Coe. For more options action, be sure to tune into the full show. That's tomorrow, 5:30 p.m. Eastern Time. Up next, final trades. final trade, Tim.
Yeah, Walmart. Again, they deserve more of a hybrid multiple. Only 7% of global of U.S. e-commerce sales, and I think that is growing. Walmart.
Chairwoman.
Yes, if you can buy Facebook down in the 20s, I think it's worth a look for Monday for sure. It's been hit twice on the same thing.
Pete.
Seeing a lot of great activity in NVIDIA, Mel. I think this is still going a lot higher.
Guy.
I wish I could see Tim's rig. I don't have any return, as they say. I'm with Pedro, except I'll go the AMD route, not the NVDA route.
All right. Thanks for watching Fast Money. See you back here tomorrow at 5 for more Fast. Meantime, Mad Money with Jim Cramer starts right now.